here last time, just a really quick recap. DMS is, I'm not an organization, I'm a person, but I call it dual momentum systems. And so what is dual momentum investing? It's combining two different forms of momentum. The first is absolute momentum, also known as autocorrelation, and the second is relative momentum or relative strength. So generally you have at least two, but possibly more different broad-based equities that you're indexes that you're investing in. And the first check is to see if those have positive momentum. And if one or more does, you go into the one with the highest relative momentum, relative strength. If the equities are not, or if none of them are in an upward momentum, then it goes into treasuries or bonds. And Gary Antonacci, I didn't put his name on here this time. I should have. My bad. He's kind of the godfather of dual momentum investing. Really brought it out to the public, and a lot of credit goes to him for not just figuring this out, but also making it known for people like us to take advantage of. There we go. So what's different about dual momentum systems? What am I doing differently that Gary and others haven't really done? And the first of the two major things I would mention is one is the shorter but weighted average look back. Dual momentum systems tend to use a 1 year look back period, 12 months. And I do a weighted look back that looks at 25% of the 1 month returns, 25% of the 3 month, and 50% of the 6 month. And what that does is, and I mentioned this last time, but if you didn't remember, when I was first working these models back in 2017, I was able to get some data to test further back. And I realized that in a plain vanilla dual momentum model, my look back versus the 1 year look back, there really was not a difference in long-term results. I preferred the weighted look back though, because you tended to get in and out a little quicker. It also makes for a little more whipsaw, but basically there are extended periods of time where one will outperform the other. But if you have a long enough time frame, they tend to equalize their performance. However, what I was able to find out though was using this weighted average look back that I do, it enables us to do two other things. And one is slice up the US market a little more granularly to try to extract a little more profit out of there instead of just going with the S&P or a total US market. And the other thing is using leverage, either through what I've called smart leverage, or even in the case of like Max Payne, it's in 3x leveraged all the time. It's a wild ride, I can tell you. I'm in it myself a little bit, but very volatile, but it also has just tremendous risk-adjusted figures if you can stand the ride. Smart leverage, I just mentioned. What is that? I came up with this, unfortunately, too late to take advantage last year, but basically I was reflecting on the drop last year we had in the market and what might be a way to systematically handle similar drops in the future, not with respect to getting out, because the dual momentum already puts us into treasuries or bonds. Not always for a drop as quick as last year. We were fortunate, and the strategies had us out before that drop. But especially in a protracted, long drawn out, like from the top of 07 through early March 2009, that's when absolutely a dual momentum is going to get you out, period, over that period. You may pop in if there's a false rising market, you may get in and then have to get back out again, but you won't suffer a long, protracted, down draw like that. And so the smart leverage was something I came up with when we have an outsized drop in the market. Instead of going in to say VTI, the Vanguard's total index fund, total US market, why not go in with leverage the cards are kind of stacked in your favor. Let's take advantage of it. And fortunately, in preparation for this last time, the meeting I did with you guys, Don had didn't force me to or anything, but he kind of encouraged me to get more metrics for my numbers that I had. And it's actually been just fantastic having those metrics around the results and drawdowns and everything. And what I'm able to see now that wasn't so clear before, but when you add the smart leverage in, things like the drawdown, which I did track that before, but the ulcer index, the risk adjusted metrics, they all look really good, even leveraging up with smart leverage. It really does not detract from being a less volatile. It doesn't add a lot of volatility for the most part. Now, Max Payne is a definite example, but that's not using smart leverage either. That's full-time leverage. Okay, updates and changes from last time. So I have, I say investors, I'm being generous. I have one investor in particular who's a rather large retail investor. We met on the Bogleheads forums, and he's been using my strategies for maybe a year and a half now. And recently, really earlier in the year, I came up with a couple new strategies. I was trying to, the strategies that I had were very risk averse from an aggressive person standpoint. I'm trying to phrase this properly, but I'm not a big risk taker personally, and I guess basically the strategies were more tailored to my outlook on investing. But this individual was asking about higher risk, but still quality as far as risk adjusted returns. And that's when I started looking at expanding the smart leverage, going into more aggressive than just TLT, these sort of things. But anyway, at the end of the day, some of the things that I came up with, he couldn't use them. He said they're not suitable for a whale investor. You know, he wasn't bragging, but he can't go trade $3 million of MIDU, which is the 3x mid-cap S&P 400. It just doesn't trade that much volume in a day, you know, and he doesn't want to spread it out over a week and micromanage his purchasing. It just didn't work. So I started looking at what changes I could make that would better suit what I'm calling a small fry to a, oh my gosh, what's the term I have for the other one? Big fish, sorry, a big fish or a whale, which this person I've been mentioning. So the USA small, medium, large strategy was actually very new, and I decided to just cut it. It was really only suitable for a small fry investor, and I was able to come up with the Russell XXL, extra large, right? Extra large. It's just a more aggressive version of the Russell. It goes into 3 times long-term treasuries the first months it's out of equities. And then the subsequent months, if it's out of equities, it goes into EDV, which is Vanguard's extended duration fund. Whereas the Russell goes into TLT, long-term treasuries, for not just the first, but all months it's out. And then the Russell XXL, instead of using 2 times like the smart leverage with the Russell, the XXL uses 3 times funds. So if IWB, the Russell 1000, if that's the winning component when you get back into the market, the XXL will go into UPRO, which is a 3 times S&P, but it's a virtual spot on correlation for the Russell 1000. So I have ratings now for all the strategies. Small fry is up to a $500,000 allocation to that strategy. Big fish 500, and whales 2.5 million and above. And I'd have to go back and double check. Don't hold me to this, but I believe all of the strategies now, with the exception of Max Payne, are whale friendly. If you're fortunate enough to have that kind of money, it won't be a problem executing trades with those dollar amounts. And some of the changes I made on that top bullet point, you'll see it mentioning TLT. I forget if that's iShares. I'm not sure whose that is. VGLT is Vanguard's long-term treasury. And just look at the median daily share volume traded on those two. You know, it's less than 700,000 a day for Vanguard's fund, and it's almost 14 million a day for TLT. Even though 647,000 is a pretty good number, why not just go with TLT? You know, it's got so much more people investing in it. It just made sense. And gosh, I didn't, oh, I do have it written down. So I'm gonna go to the next page here and I'll show you. So these are the underlined text is showing what was changed. So Global Navigator, I was trying to have that one be a little more conservative. And for smart leverage to kick in, it had to hit previously a 20% drawdown in the VTI. And as I was going through this exercise of trying to make the strategies larger investor friendly, I thought to check, you know, maybe I should just bring this in line with all the other strategies which use 15%. And it made sense. It raised the CAGR a little bit, and the Ulcer Index did go up, but very small number. And it just kind of, it makes it easier to keep everything at 15 that way. It works very well. I mentioned VGLT a second ago. I switched the out of equity, the treasury bond portion to TLT. The only change to the Russell was going to TLT from VGLT as well. The Russell XXL, gosh, I didn't highlight anything on here. I don't think I changed anything from last time on. Oh, actually, no, sorry. This is all new since the last meeting. That's why. So again, this was brought up a more aggressive version of the Russell, but since IWS, which is a component of the Russell, that is the Russell Mid-Cap Value ETF or index, there is no leveraged version of that index. There's absolutely nothing out there, which is, I think, unfortunate. But so what I did instead is for the Russell XXL, I swapped out the mid-cap value for the Russell 2000 IWM. And that way they all three of those in effect have a leveraged option. I realized triple Qs is not exact IWP match. But if you look at the correlations for the Russell mid-cap growth, which is what IWP is, it's extremely highly correlated to the Qs. So until, and there probably never will be, but until there's a leveraged version that we can use for the Russell mid-cap growth, I'm using TQQQ instead. And Max Payne was using, gosh, I think it was UMDD was the ticker symbol. And I forget which is Direxion and which is ProShares, but essentially it was a 3x mid-cap option. Even though Max Payne is still small fry only, it's not, I mean, I don't know, discretion. I guess if you're a big fish, you might still be able to use it. But MIDU just had so much more trading volume on an average day than UMDD did, that it made sense to switch that. I highlighted EDV on here. I don't recall, without going back to look, what changed with that. Maybe it was TMF all the time and I backed it off to EDV. I'd have to double check, but that's a minor point for that one. So I don't know, less than a month ago, I thought I was done monkeying with my strategies, and I guess I'm a tinkerer at heart, and I have some money in a college fund for my kids invested. I've got, you know, my personal savings account. I'm not talking 401 or, but but money that people might otherwise put into a savings account. I don't. I put it into an investment account, and this is my emergency money. It's savings for vacation. It's kind of a combination of things. I just stick it in one account. But I had been using the ETF SWAN, SWAN, which God, I can't remember the Black Swan guy, Nasib Talib. I can't remember his name. You guys should know who I'm talking about. He came out with the Black Swan book, I don't remember, years ago. And Swan was inspired by his work. It's a barbell ETF that uses, I think, about 85% in intermediate treasuries. And then they use futures for the other 15%. And it captures I mean, it can vary year to year, but over a long term, it kind of acts similar to a 60-40, but it has less volatility, the way it works with the futures and the intermediate treasury holdings. So I don't have a fortune invested in Swan, but I use it in both those accounts I mentioned. And, you know, probably like a lot of us, I've been in the back of my head thinking about the end of this bull market for the bonds, what with interest rates kind of bottoming out, and I don't know if it happened last year or this year or next year, but you know, we're in that bottoming process and likely to be experiencing rising rates for the unforeseen, you know, future, I assume many years. And I'm just not excited about holding, well, I'm not excited about holding bonds ever, really, but in a product like Swan, where 80% of your money is sitting in an intermediate treasury, I'm really not happy with the thought of that, because I don't expect treasuries to do well in a rising rate. It's just, I'm no treasury or bond expert, but I know that much about them. So Triad came up. I was just really trying to think, can I come up with something better than a 60-40 that has similar, you know, historical performance, and I think we'll have a lot better going forward performance, low volatility, low drawdown. You know, I want to be able to capture some market gains, but I don't want to have a lot of risk for these circumstances. I'm not interested in putting it in too risky, because I need the money, or I could need the money sooner than later. So that was the impetus for seeing what I could come up with Triad. What is Triad? Well, it is a dual momentum strategy. It's a little different than my other ones. You guys may have seen things like Meb Faber's IV, or some of Trend Explorer's, what's he call it, Global Protection Momentum, GPM or GMP Momentum Protection, Defensive Allocation, something DAA. He's got several strategies that are aimed at getting returns with low risk. And the problem I had with those type of accounts is they trade a lot. You know, those strategies like GPM, GMP, and DAA and all that stuff, they trade in and out every month. They're just not very tax friendly at all. And so I kind of had a more pared down thought to this. And I thought, let's pick three things. The broad market in the Russell 1000. I do like that Russell mid-cap value, and it moves differently than the 1000. So let's pick that one. And then the last one was gold. I'm by no means a gold bug, but I respect the metal. I think it's a good long-term holding, but I'd rather use the benefits of dual momentum and hold it when we should be holding it, and not holding it in down periods. So the approach I thought of is let's take those three components, put up to 1/3 into each of them if the momentum is positive for them. And for any of the 1/3 that does not have a positive momentum, this is where and the look back, I'm not going to go into it. I'm going to keep it under the covers right now how exactly I'm doing a look back on this, but it's not the way to look back that I do for the other strategies. I knew that that would induce more whipsaw and shorter trading. And this is not a 1 year look back, which is standard. It's not a 10-month look back. It's not my way to look back. This is something different that I implemented. So kind of similar to how there's 3 options to invest 1/3 each into. I also have 3 options of treasuries and similar. I have short-term treasuries, intermediate-term treasuries, and short-term investment grade bonds. So the one of those 3 that has the best relative momentum is where any uninvested money from gold, the Russell 1000, and the Russell Midcap Value is parked into. So you may have nothing in those. I'm going to loosely call it treasury. You're going to have either nothing in those, a third, 66%, or 100%. And I'm saying a third. You know, I use M1, which I really like, but you can't do fractional percentages. I didn't want to make it confusing, so I'm doing 34% into the Russell and then 33 each into gold and mid-cap value. Depending on what time frame you look at, the triad is really competitive, not just with the 60/40, but also the S&P 500. And I say depending what time frame, because in the late 90s, early 2000s, stocks were on fire. This strategy underperforms in relation to that overperformance by stocks. However, you look at the early, I can't remember what year the bomb hit, 2002, maybe something like that, from 2001. Those tank, and this strategy did not. It keeps going. If you look at 07, 08, 09, same thing, the markets tank, the equity markets tank. This does not. So it does a really good job. It's got great drawdown characteristics, really low ulcer, and it is competitive over long-term with the 60/40 historically. That was great. I was just hoping to get in the ballpark. I think it's going to do a lot better going forward because of the those short-term to intermediate-term holdings that we're putting the money into, and it picks the best one. So if things are looking good, it'll go into intermediate-term treasuries. If the treasuries are not performing well, the short term is the way to go. I should have put a graph on here for this, but it's really interesting. If you look at the last several months, maybe this last month excluded, but if you look at from maybe November last year through say March this year, pull up long-term treasuries and pull up short-term treasuries, and it's shocking because you look at the long-term and they're just cresting and you know, doing a waterfall going down, and the short-term, I don't believe they ever went negative. I think they certainly leveled off, but they kind of kept going. So that was the thinking I had behind this, is let's keep it short to intermediate, keep it safe, and not put the money at risk. Sorry, I got someone walking outside my office here. What I did not plan on, but I'm really happy about, I took a quick look at the tax. My models, it's not conducive to doing an exacting look at the tax effect of the strategies. I can get a general sense, but what I did do is I took from 2000 forward, and I looked at how much of the gains were short and long term based on just a year time frame, and 80% of the gains from 2000 to as of maybe say a few weeks ago, over 80% of the gains were long-term. So just fantastic, especially considering where I personally want to use this account, which is in taxable accounts. So I couldn't have been more pleased with that. Whoops, here we go. So I know there's a lot of info on here. If you have received my deck or looked at it, you know, I wasn't real condensed with information. You know, each strategy had a title page and then 5 pages of info after it. I'm in the process of redoing my whole deck right now. I'll get to why in a minute. Well, I guess it's right here. You can see, but I have data now back to 1980 for all the strategies. So I'm having to rework my deck to accommodate all that. And the deck is getting just so dang big. I thought, let me revamp these fact sheet pages, if you will, and instead of doing a total of, instead of doing a total of 6 pages like before, I've got it down to 2 pages now. So I've got the description up on the top right there. On the left top, it shows the investments for next month. And I know this says as of 5/31 and for June. That's because I just ran this after today's market close. It's really as of today, and those investment selections for June are not final until May is final. So don't look at that and think that that's accurate. It's not as of right now. But assuming this were the final deck at the end of the month, it shows where your investments should be for next month. It mentions the tax friendliness, talks about the average months between any change of holding. Now for Triad, it's a little different because all my other strategies only have a single investment for the month. You're in, say, the Russell 1000, you're in MIDU, you're in TLT, you're in EDV. You never have multiple holdings at any one time. In Triad, you have, oftentimes you have 3, you can't have 2, and you can't have 1. So when I say it has 2.33 months between a change, that doesn't mean all the holdings change. You know, maybe it was holding gold, the Russell 1000 and the Russell value. Every, call it 2.5 months, one of those might change. Maybe you get out of gold and go into treasuries. Maybe you get out of the broad market and go into treasuries, whatever. And to go back to that tax point for a minute, it'd be easy to say, well, Josh, you're making a change every 2.5 months. How can this be a tax-friendly strategy? And the reality is that a lot of the short-term changes did not result in much gain. Most of the gains came from holdings that were held for a year or longer. So it was really that simple of the reason why, which is, I thought, again, fantastic. Portfolio size appropriateness. This one's a whale, could be a large fish, could be a small fry. And then the section with the 4 components down there for the CAGR, the max drawdown, Ulcer Index, and Sortino. Those are my personal favorites to look at for the strategies. So I have them all for year to date, 1, 3, 5, 10, from 2000 to current, and from 1980 to current. I think it's just a nice, simple way to see all those numbers from that time forward. Normally, for all the strategies, I would only show the S&P 500, but Triad is really geared against the balanced 60-40 portfolio. So I felt it was more appropriate to put that one in here. That's really the target for this one. However, if you look from 1980 to current, the S&P has done just under 12, and Triad's done just under 12. Not bad. If you look at 2000 forward, it actually crushed the S&P. And that's because not long after 2000 is when we had a dot-com bomb, killed the S&P's performance for the decade, basically, and it did not for Triad. So anyway, I'm not gonna go through all these numbers here, but I think great information to look to. And then I took what used to be a whole page of the percent time and percent gain, excuse me, and I threw them into these 2 pie charts to show how much of the past 20 years was in which of those components and how much of the gain came from those components. So I didn't bother putting the percentages on, but you can see that it's roughly about 25% of the time, maybe 27 or 8% is in the Russell 1000. Yet, if I had to guess, I'd say that's maybe 40% of the profits came from it. So kind of interesting. And for the gold naysayers, you can see that it does bring in less profit, a percent of the profits as its percent of time. However, gold is one of the only reliable investments out there that I'm aware of that's kind of not just counter-cyclical, but tends to do well when the equities markets are doing bad. And I'll be honest, I was really interested in making the triad some kind of quad number. I was really hoping to include commodities. And my original thought was maybe take commodities and gold and have them be a little smaller component. I don't know, maybe 20% each, and then weight the equities higher. But at the end of the day, I wasn't able to get broad commodity strategy returns previous to about 2005. And in testing out gold against the commodities, I realized there was really no reason, because gold did a fine job. I really didn't need that other component. And so this is condensing what used to be 2 pages into 1 page. I just squished both graphs, but it shows the equity chart with the relative strength, in this case versus the 60-40 from the start of 1980 forward, and then the drawdown from that whole time period. And if you look over at the very left of that drawdown, in the very beginning there, you'll see the triad dumped. And ironically, that was, I think, the second month of history that I had from 1980. It's, I didn't know this term, but I looked it up, and they're calling it Silver Thursday. It's when the Hunt brothers cornered the silver market. I remember that. I was in high school at the time, but I remember that event. I don't remember how it played out and why it tanked metals and the markets, but it did. And
they tried.
The strategy was in gold and the broad market when that Silver Thursday hit, and it just crushed both of them. So, in the scheme of things, a 17% drawdown is not the end of the world, but it's just ironic that it hit this strategy. I think it was the second month that I had data for. As you go further over towards 1988, you'll see kind of a double dip there for the goldish line. That was around the flash crash in October '87. And I will say, I was surprised. I had thought that my look backs, well, not for Triad, which is a little different, but I had thought the look backs for the other strategies, the weighted look back, I thought they would have got out in time to avoid that crash in '87. And every single one of them was still in the market for that flash crash. So I was surprised by that. And I joked with someone else that, well, gee, I'm going to go tweak my strategies now to avoid. No, I'm just kidding. I'm not gonna look at that and change something. It's just the way it is. As I mentioned earlier, some of these quick drops you get out in time, and some you don't, and that's just the way it is. But then as you look across after that flash crash, the drawdowns are all pretty good. Pretty similar for the most part, except those 2 big dips around the dot-com bomb and around '08. The 60-40 had much worse drawdowns around those periods. So I was impressed. Again, I wasn't trying to beat the 60-40 in the past. I was trying to beat it in the future. And I was really happy to see this performance with it. So moving on to the long-term part, I really only had data back to 2000 forward for everything. I did have monthly data for the Russell products to about 1996. But that didn't give me an extra decade. I ran the results, and the late 90s weren't spectacular. They were okay. But I kind of like, I mentioned earlier, I like looking at decade results. So going to the mid 90s didn't really excite me, but a friend of the strategies was able to get a lot of data to me, and it was really great. He got me daily Russell indexes from the beginning of '97 for the Russell 1000, which is similar to the S&P, the 2000, which is small cap, 3000, which is akin to the total US market, the Russell mid cap, and then the Russell mid cap growth and mid cap value. Those are both newer Russell strategies. And I have full data for those from '86 forward. He also got me the S&P total returns monthly, not daily, but monthly back to before the crash, back in the 1920s. And he got me several different bond indexes, Ibsen or Ibsen, and a bunch of them were ICE, and I can't remember all of them, but he got me like 90-day T-bills going back, way back in time, some of these bonds and whatnot. And it was fantastic, because this guy's actually, I don't know if he's actually investing in them yet. I think he's evaluating my strategies, and he wanted to see how they handle all the bad times we've had in the past. So he's like, well, show me before 2000. I said, well, I can't. So he has connections and got me this info, and so I started going back in time. So I mentioned how I simulate leveraged ETF data last time, and I thought I'd just kind of show. I had to redo them all with this new data. So I think my numbers are better than before with regard to the leveraged ETF data going back in time before they actually traded. This example on the right, the chart you see, IWM is the Russell midcap, UWM is the 2 times leverage. So as you look at that chart, the orange is the actual UWM ETF. And then what I call UWM sim, I simulate that off my data. So what I do is I take the daily numbers. I first generate monthly numbers, so I have monthly for the index back in time. And then I take the daily numbers and I apply 2 factors to them. For a 2x, I start with a 2.0 multiplication. So if the daily gain was 1, it's now 2. And then I apply an expense ratio, and I start with 3% because there is a cost to these leverage funds. They have to, they incur cost when they leverage. And then, so what I do is I take the portion of time that the ETF actually traded, and I overlay my sim data with the actual ETF. And then I start playing with the leverage factor and my expense factor. And I just by eyeballing it, I try to get the lines as close to overlapping as I can, which tells me that my sim data is it's as close a match as I'm able to get to the actual data. And you can see there are some slight differences, but all in all, this one tracks amazingly close. I mean, it looks really good. So once I get the charts or the lines overlaid on the chart, I call cut, and I go and I take all the previous sim data for that leveraged and extend the actual ETF back in time. So for all the strategies, I'm able to go back to 1980, and for Global Navigator, I go back to 1970. I will put a caveat in there. Not all of my data is perfect. I'd have to go back and look at my data, but some of the short to intermediate term, like the ones used in Triad, he didn't have data that went all the way back. And also, I don't have the aggregate bond market. I think it was all the way back. I had some other close ones, more for the treasuries. But what I did is I was able to kind of simulate those. I was able to take the ones that I had, and I'd take like X% of this one, X% of that one, X% of that one, and kind of like this sim I'm doing here, I would look at that for the combination of bond data that I did have, and I was able to pretty closely replicate and extend some of those further back in time. I have them noted which ones I don't have the actual data. I would love to fill it in sometime. Another one is UPRO, SSO and UPRO, the 2 and 3x multiple leveraged funds for the S&P. I only have daily data back to 1980. So anything before 80, I can't do this process. You just can't do it with monthly data. It doesn't work quite right. And what I did for those 10 years before 1980 is I did take a swag at it from the monthly data that I have. So it's not all perfect based off daily data, but there's really only a couple instances where I don't have it on the treasury and bond holding. I got it really close. I realized I could have a little variance on my 2 and 3x S&P data, but until I can get daily data going back in time, it'll have to do. So this is not from the deck. This is a separate little sheet I was doing at the time to look at long-term numbers. This, you kind of saw this triad, a very similar graph already in the fact sheets I was showing you. But I just took a look at all the strategies long-term to see how it looked. I have up here by decade, the return, the drawdown, the Sortino and Ulcer index. And then I have the entire period from 1980 forward. So again, you can see from the numbers, it looks great from the whole 1980 number, right? The CAGR's higher, the drawdown's less, the Sortino's higher, Ulcer's lower, and of course, because of CAGR, the ending value is higher. I mentioned before I looked at decade numbers, and you can see if you look over here, 1980, it did 14%. In the 90s, it did 10%. In the 2000s, it did 12.5. Okay, but pause. You can see the 60-40 only did 2% that year, right? And they're both doing or did 9+%. So I guess it's just a factor of the strategies and how they work. I'm not taking credit myself. I think it's the dual momentum structure of it, but they tend to be really consistent decade to decade, good times, bad times. They just have really performed amazingly consistent over time. It's shocking to me. So this is triad. I'm not going to go through these in detail, but just to show you real quick. I'm calling this the Russell OG now, the original Russell. This was the one I had before I had any smart leverage in with it. And again, if you just look at those CAGRs real quick, 19, 14, 17, 17, very consistent. It's just really amazing. GEM, this is Gary Antonacci's strategy, Global Equities Momentum. I just put it in here for reference. So you can see if I back up here real quick, the Russell OG in a tax deferred account, if you could have traded this back then to now, would have returned 10,000 into 6 million, and GEM turned 10,000 into 4 million with the Russell, with the Ulcer index of 5.6. Actually, it's a little lower than the Russell OG. It's just for reference. I don't use GEM, but it's just a reference point. Here's Global Navigator, and this is using smart leverage. The Russell OG did not. This one goes into 2x when the smart leverage kicks in. And you can see the bumps going along in the chart. If you go back and look in the early 80s, like 82, you'll see it just really picked up there. And that was a long period of time where smart leverage had kicked in. It went into leverage and it held it for a while and it got some huge gains. Same thing in the mid 80s there. And then as you look at the dot-com, after the dot-com bomb, it's about 03, that's when the market started coming back. And again, this took advantage of it. And it doesn't look like much on this chart because it's such a long time period, but in 2020, this strategy had a huge pop as well from using the smart leverage at that time. This chart shows the Global Navigator back to 1970, one extra decade. Ironically, if I go back up a page here, it's 20.87 CAGR from 1980 to 2020, and it's 20.27 from the 1970 forward. So I was pretty content having 2000 forward data. It makes me a lot more comfortable with the strategies, seeing all this history and what they did in various timeframes. I honestly don't know that it'd be that helpful to go too much further back than 1970. I know World War II was kind of a crazy time, obviously, in the world, but regarding investments, things were really kind of weird. And I don't know, I guess it'd be a curiosity to see how it did, back to the early 1900s. But until that data presents itself, this is as far back as I'm going to get. Here's the Russell, very similar metrics. This one was kind of interesting to me, actually. If you look at 2000 forward, the Russell beats Global Navigator by a fair margin, if I remember, a couple percentage points. But when you go back to 1980 forward, they're almost identical numbers. In fact, I think the Russell might have underperformed just by a hair. So interesting how a different time period can influence your decision on strategies one way or the other. And then Russell XXL, this is one that goes into the 3X. You can see just some massive pops along the way when the smart leverage kicked in and worked. And from 1980 to now, getting close to a 30% CAGR. I mean, that's darn near doubling your money every 2 years. That's pretty crazy. Max drawdown of 30%. Really attractive strategy to me. I like this one a lot. And then max pain. Let me just back up again. Notice here on the Russell XXL. Look at that line, and you'll see it does go, up and down a bit. It's not a smooth line, but now look at the max pain line. Wow, it really has more movement. It's a lot more volatile. If you look at the 80 to 2000 metrics there in the kind of the center top, you'll see the max drawdown is 67%. Wow, that was the flash crash. It had a negative 7% month the month before the flash crash, and I think like a maybe 63% the month of, and I think I had that off a little bit. Anyway, the aggregate max drawdown over that 2 month time period though was 67%, quite a hit. And it took, I think it was 5 years to get back to where it was. It actually, if you look there just to the right after that big drop in 87, you'll see it start climbing pretty quickly, but then it had another dump. I can't remember what event, if anything notable that was, but about 2-3 years after the flash crash, it had a 20% negative month and a 26% negative month. So it really hindered that recovery. But you can see that by about mid 92, it overtook the previous high water mark and never looked back. It's just been killing it. Over 37% CAGR over this time. And the ulcer index is high. It's painful to hold. I can tell you personally, it's painful to hold. But when you look at the ulcer index of the S&P at 13 over that same time, and this having a just crazy high return in comparison, right? So for those 40 years, the S&P turned 10,000 into almost 1 million. Max pain would have turned 10,000 into almost $5 billion. I realize it's impossible. These funds aren't that big, but I have an allocation to it. I can't resist. I won't lie. I'm going to pare down my metrics pages in the deck down to 2 pages, and I'm calling this the modern era, 2000 forward. So same as before, if you've seen my deck, shows all the metrics for all the strategies. And then the next one I'm going to show is long-term metrics from 1980 to current. I do like having decade, but it just makes the deck too darn big. As I start adding 4 decades, that's a page for each decade, and then an overall page. It's just too much data. If someone is really dying to see it, just let me know and I can get it to you. But going forward, I'm just going to offer a two-pronged look, 2000 forward and 1980 forward. So this is a snapshot off one of that previous page I just showed you. But as we look at Triad, I think actually, let me double check here. I think that was 1980. Yeah. So from 1980 forward, Triad had a ulcer index rating of 3.27. And you'll see that the next lowest rated strategy is, in a good way, right, is Global Navigator at 4.78. Well, how much better is, I mean, you can see the number, you can tell me it's 1.5 better, dummy, right? But what does that really look like? How much better, how much less ulcerous is Triad than Global Navigator? So what I did is I took the 2 of their drawdown profiles and overlaid them on each other. And you'll see that the Hunt Brothers event on the far left part of the chart, it was a worse drawdown for Triad that time. But as you look across, you see a lot more shallow drawdowns for Triad than for Global Navigator. And this is the graphical representation of that aggregate, pain number that the ulcer index represents. So I won't show these kinds of things going forward in the deck, but I just wanted to illustrate how much less volatile Triad was than Global Navigator. This is where we stand today after the close today with the strategies. That box on the left that shows the strategy day, month, year, and then the benchmark numbers. I have those on a Google Sheet that you can access at any time. And I actually had to pull what was a condensed version of this chart. I don't know what's going on, but the data that gets pulled to generate this chart's on a daily activity, not monthly. And it just doesn't play well with Google. I was having constant issues with the chart not drawing properly. So I had to pull that from Access for everybody. You do get that strategy, the figures on the left. If you notice, I've got them heat indexed for each column. So for the day, you can see Max Payne had the best day, Triad the lowest, and for the month, the two Russell and Russell XXL are the two worst, Max Payne the best. And then same for the strategies below. On the chart to the right, you'll notice, that hot pink Max Payne, up, down, up, down. It is crazy. And then the orange line is technically the Russell XXL. If you look down at the legend just to the left of that, you'll see the Russell in a red dot or a rectangle. And you'll notice there's no red line on the chart. And that's because the Russell and the Russell XXL, when they are in equities and when there is no smart leverage, they are the same fund. So the orange is simply right on top of the red. You just can't see it, it's there. And you can see Triad's down at the bottom, but not doing badly, but having a good year. But just from a CAGR perspective, the lowest of the ones this year, not a surprise. Also, the less volatile. I thought I'd just show here some numbers. These are just some quick little numbers I have on my model so I can look at stuff quickly. It shows the average months held, the compound annual growth rate, the max drawdown, and the ulcer index. The one on the top and to the left there, it says Global Navigator on that little screenshot. That's Global Navigator as presented in the strategy and how I actually have used it myself. And I thought I would show, gosh, what happens when, because Global Navigator uses smart leverage. So when there's an outsized drawdown in the market, it goes into SSO. And I said, well, what would happen if we went into UPRO, the 3X version of the broad market instead? And you can see the CAGR goes up from 20.2 to 22.8, pretty healthy increase. And the ulcer index goes up a little bit from 475 to 5. The drawdown didn't change. So if you're a more aggressive person, that's a pretty interesting profile, right? Well, then instead of going into TLT for the first month, what if we went into extended duration? And hey, look, that adds almost another % CAGR to the strategy. And wow, it actually lowered the ulcer index by being more aggressive. That one surprised me. After that first month, all the other months would have been in, so all the months in treasuries would have been in TLT. I just wanted to break it up to show you what if we did the first month EDV, the rest TLT, and then that fourth picture there shows EDV all months. And that's still using UPRO, by the way. I did UPRO and then I started incrementally getting more aggressive. So by having UPRO instead of SSO, by having EDV for all months instead of TLT, we added over a 4% CAGR to this strategy. It went from 20.28 to 24.5. And yes, it got more ulcerous, went from 475 to 528. But that's not a crazy increase in volatility for an extra over 4 CAGR. That's over the years, that adds up to a massive difference in profits. And then I said, okay, what if we went into now, and let's go one further. Let's go triple long-term treasuries for the first month and then EDV for the next months. And look at that. Now we're almost at 28 CAGR. Crazy, right? The one that kind of pops back to the left, that's because I'm not successively getting incrementally more aggressive. I kind of backed up. I went back to the basic global navigator, and I said, let's keep SSO all the months, and instead of TLT, let's go into EDV. And it took that original the actual global navigator from 20.28 up to 22. Pretty good. Ulcer index went up a little bit, but not crazy. So I guess I'm just showing this. I do think about these things when I'm doing the strategies, and ultimately this is not a business for me. It's a hobby for me. But it's more than that. It's my money I'm investing, but I try to treat it the deck I've done, if you've seen it, I hope it's something of value to you. I hope it provides information in a clear and concise manner and all that. And I do it. I try to treat it as though it's more than just a hobby. It's important to me. It's my future, financially speaking. But the fact of the matter is, I just don't have the interest in saying, okay, here's the base global navigator, and here's 10 variants that you could pick and choose from if you want to ramp it up or ramp it down, so to say. What I do instead, and what I've tried to do, is offer a suite of strategies from Triad, ultra conservative, low volatility, the Russell OG, no leverage, good conservative strategy, global navigator, which has some smart leverage, but not super aggressive most of the time. The Russell is very similar. Then we start getting, if you want to get real aggressive, I have the Russell XXL. And then if you're insane, Max Payne. So I guess you could ask, why not, why have all those strategies? Why not just have Global Navigator and go with a conservative version of it and go with a more aggressive version of it? And the reason is it's just diversity. The Russell and the Russell XXL are amped up versions of each other, and as such, they move very similar to each other. Global Navigator is when it's in equities, it's generally in the U.S. market. It's sometimes in foreign. That's a different holding than the Russell and the Russell XXL have. Russell OG is even different still. So I like to have different options that have different base components, because I mix and match. I don't put 100% into this or that strategy. I'm actually still evaluating how I'm going to do my IRA, but I think what I'm going to do is probably something like 50% Russell XXL, maybe 30% Global Navigator, and 20% Russell OG. I'm not necessarily trying to pick the highest return options. I'm trying to pick a variety of strategies that will complement each other. They hold a little different components, and I just think that's not a bad approach. Treasuries. I kind of touched on this a little bit with Triad, but I think most people out there would agree that the bond bull market is or is about over. Again, that's how Triad came to be, trying to figure out a different way to do a 60-40. And by the way, as a side note, I listen to a lot of podcasts. I enjoy the Barry Ritholtz Masters in Business, I think it is. And lately I've heard a couple of his podcasts where he's interviewing very well-respected, well-regarded people in the financial industry. And he's asked them, he kind of queued it up similar to what I just said. And he said, hey, what are you guys doing for your clients now that 60-40 doesn't look so attractive going forward? And without poking too much fun, their answer was, well, we're now going to do 70-30. I'm sorry. I think there's a better way to do this. So maybe I need a consulting gig with these firms and I can show them a better way. But regardless, the unknown question that we don't know until we get into this rising rate environment for sure, and until we get a downturn in the market and go into the treasuries, we just don't know exactly how it's going to act. Again, these strategies hold one component at a time. So while we're in the market, we're not hedging by holding some percentage of treasuries. We're 100% in the market or 100% in treasuries. I don't have any great insight into this, but what I hope happens is that just like in the in historical times, it's a flight to safety. Gold is a flight to safety. Other metals as well, commodities, utilities, treasuries, bonds. A lot of people get freaked when things go down and they have this flight to safety. So my hope is that even if treasuries are not doing well on an ongoing basis, that for the times we are in them with the strategies, that they have positive performance, that they see a lot of incoming money, drives the prices up, we do well, and then get out and get back into equities as they maybe languish and downturn a little bit. We won't know until we get there. I will say though that the 1970s, I'm no scholar on this. I've been told the 1970s was a rising rate environment, similar to what we are likely going to experience here. And I will tell you that all this, the Global Navigator, it did great in that decade. I did go look at the percent of time and percent of profits the Global Navigator made in the 70s versus the 80s, 90s, et cetera. And it really wasn't any different. So I didn't see that data before I had this thought about flight to safety and all this, but it kind of confirmed to me that maybe we'll be just fine without changing anything. However, that last bullet point simply mentions that if treasuries, no offense, but if they just shit the bed and they don't perform for us, even the limited time that we're in them, I can always migrate the strategies to use a similar option to what Triad does. I can look at those short and intermediate term options and pick those. And if that is the case, it will take a hit in performance, but it's not terrible. I should have thought to jot the number down, but I can look at my strategies and go to cash instead of the treasuries. And it's certainly not as good a performance as they do with the treasuries, but it still beats the S&P. It's still better. It wouldn't be the end of the world if that's what we had to do.
Questions?
I thought I had, oh, maybe that's the last page. Sorry, I guess that is it.
Questions or? Hello?
Yes, you can go ahead. I think.
Okay. Yeah, you mentioned, and there's a number of points. You mentioned the 70s and a rising rate environment. By the way, they most definitely were. I experienced that when I was young. When you can get to a 13% treasury bond and an 18% home mortgage, most of you have probably not even pondered something like that. Also, you mentioned the duration of data. I would suggest you've got it pretty well covered. I wouldn't waste my time going back before 1950. If you look at World War II, the economy was heavily regulated in that time frame by the government, and where everything was just being used as an instrument for wartime production. And so you did not have free market activities. Everything's regulated, where you don't have a supply and demand market. The other thing is, like in World War I, the stock exchanges were actually closed for several years. So again, you don't have a supply and demand market, right? So it would probably render, at least to me, a lot of any results to be kind of nil. Okay. By the way, I like your work. I think it's overall pretty great. Okay.
Thank you. Yeah, and good to hear what you're saying about the back in time. I'll be honest. I read an article that Gary Antonacci did. I don't remember, sometime in the past, couple of years ago. He was able to get data to extend his GEM model back in time. And he talked about why he went back, I think it was 1950. And he brought up some of these things that we're mentioning. He said, I just don't know how valid it is to go back further than that. I'm not confident that those were anywhere near normal enough times to really derive any meaning out of it.
Yeah, at least the 50s were supply and demand based markets, you know what I mean? That they were what they were, and not terribly bad times. There's another thought when you talk about your podcasts and who you listen to. I'm becoming very concerned about listening to any of these characters. I noticed, like on Bloomberg, if you watch them, all of their alleged experts seem to only parrot what the Biden administration is saying. If Biden is pumping a new stimulus, all of the people they have on there are saying, "Oh yeah, we need the stimulus, and don't worry, there won't be inflation." And then they pass it, and 3 weeks later, now they're talking about inflation.
Yeah.
Right. So the question maybe to you is well, who do you trust in terms of listening to podcasts or whatever? And do they seem to parrot too much what the government is saying or the Fed is saying? The Fed, for example, the Fed today seems to have no independence whatsoever from the government.
So on that point, I will tell you, I've been a cable cutter since about 2006. I don't have cable TV. I do have a TiVo and antenna, and of course I get, things like Netflix and whatnot. So I don't watch any CNBC, Bloomberg, any of those. I don't have those channels to watch. I don't listen to any radio. I get most of my audio through podcasts. I listen to a variety of things, but in the investment side, I don't always listen to those Barry Ritholtz Masters in Business, but I do enjoy. I'll go through and pick ones and listen to the ones that look interesting to me. I do listen to Peter Schiff, and I'll put an asterisk. He's hard to listen to, and he kind of cuts over the same things all the time. Very much non-mainstream though, which is one reason I listen to him. I like his perspective on things. He tells what he's thinking. He doesn't sugarcoat it. I do still listen to Meb Faber's podcast. I no disrespect, but I really couldn't recommend it anymore. He does a ton of private equity investing, and for the most part, what his podcast has now turned into is interviewing founders of the companies that he invests in. Not bad information, but I just don't find it to be that relevant for a retail investor. I would highly recommend, though, if you go back and look at his feed, go back and play any interview with people like Mark Yusko. God, I'm forgetting the other names. He does some Rob Arnott. He has some interviews with names you would recognize, and he's a really good interviewer. And then the other episodes of his that I highly recommend, or they used to call them radio shows on the podcast list. And those were episodes where Meb would just talk investing basics, things people either forgot or didn't know. And I tell you, I got a lot out of those podcasts. I thought they were really fantastic. I did enjoy. I read Jeremy Siegel's book, Stocks the Long Run. Just that kind of stuff makes you think. So I tend to not follow mainstream information, but and I do listen to Josh Brown. I love his what do you call it, the intro to the podcast. He kind of gets on a rant and goes through something, but he covers some pretty good information. I enjoy his as well. He's a bit cocky for me, but I enjoy the podcast.
Hey, Randy.
Yeah.
There was a question on chat. One of the fellows wanted to know if it's okay to jump in mid-month, or should you wait until the end of the month signal to get in?
So that I'll answer that question, and actually brought up another question that made me think of you. I honestly haven't looked. I haven't gone back and done any testing on mid-month versus the end of the month. I guess my thinking is I would personally just wait until the end of the month and go then. You're only talking a couple of weeks, and if it has a change, you may have been in something for a very short period of time. And I'll add a question to that one. I've had quite a few people ask, should I scale in? You know, should I do some now, some later, some, you know, and I I I mean, don't take this as investment advice, but my take on it is I don't see why you would. You know, with the way I look at my strategies is every month is a new decision to be invested or not invested, and you know, in which case you're in treasuries. So I don't know why you would scale in. Either you go into the system or you don't. You know, that's just me. I'm not saying that's necessarily the correct answer for everybody, but that's how I do it.
Okay, thanks. Are there any other questions?
Yes, could you talk a little bit about your leveraged strategy? You say when you get in with the minus 15% drop, when do you get out?
Yeah, the smart leverage has just really added to the returns in a great way. So I kind of mentioned I was reflecting on the drop last year and wondering, gosh, you know, how can you systematically take advantage of that? Because if you guys remember, I mean, this one was so recent. You know, the drop in 08 was just this continual, God, every day it went down and down, down. It was demoralizing after a while. And March last year, it happened in the course of 2 or 3 weeks. It was so fast. And then it started coming back. And so the ironic thing is sometimes I have some pretty good instincts. And I thought to myself, well, I know the market has 10% corrections many years, not every year, but you know, a lot of years it has about a 10% correction. It's just kind of the average, you know, normal movement of the market. So I thought, well, what if we have a bigger than, you know, kind of normal drop? And I was thinking maybe 15%. And because my strategies are based on month-end numbers, not mid-month, you know, a 15% month-end drop is significantly bigger than what it may have been at the middle of the month. And it is kind of interesting. I went back as far as I had data, and I don't think there was a single drawdown where the worst daily drop was at the end of the month. It always seems to be somewhere in the middle of the month, and it retraces somewhat, you know, by the time the month ends. So to get into the strategy, into the smart leverage, we have to have a month-end drop of 15%. Global Navigator monitors VTI, the total US market, and all the other strategies monitor IWB, the Russell 1000. I keep Russell aligned with the ones that use Russell products. They're very, very similar though. And then, so when do you get out? Well, you get out of the leverage when the strategy has a normal change of investment. So in the case of Global Navigator, there's only 2 investment options. It's you're either in the US in the form of VTI, or you're in all world ex-US in the form of the ETF VXUS. So I think it was June last year is when we would have gotten into the leveraged version of the US markets, in this case, SSO. And I don't remember the exact date, but I think maybe in October is when the markets, the foreign markets had better momentum than the US markets. So Global Navigator said, okay, now we go into VXUS. So that's when we exit the leverage. And in the case of the Russells, where they're all US based, there's no international, they're all US. Same thing, if you were maybe in QLD, which is our leveraged version of the Russell mid-cap growth. And then late last year actually went into mid-cap value for the first time in a long time. So you exit QLD and go into mid-cap value, and no more leverage after that. You just go in the one time until there's a change of strategy investment.
Thank you.
Yeah.
Any more?
Well, I'd just like to comment on the TLT versus VGLT. I've got strategies where I was using TLT and then let's say I'd swing over to the Qs or something back and forth. And with Fidelity, with TLT now and IEF, they have this agreement with BlackRock where you have to have margin for the first, you can't margin TLT or IEF for 30 days. So I don't have any intention of margining it, but it also means you have to wait for the 2 or 3 days for it to clear, right, the trade. And so that's a problem I've had with Fidelity. So I just trade VGLT.
Yeah.
And I was wondering if anyone else had that problem, or you have that with other brokers as well.
I don't have that with M1. I do have some Fidelity accounts, but it's more like it's stuff for the my
Yeah.
kids'
Right.
college. and
Okay.
that kind
Anyway,
of
just
stuff.
bring it to your attention. You may hear about it, but
Yeah.
they have
Yeah.
what they call them, used to call them marketing agreement. Now, anyway, they just don't margin, which means even if you have an IRA with limited margin, only because you don't want to wait for the trade to clear, you can't sell TLT and then immediately buy, let's say, the Qs or SSO or something.
You've got to wait a little bit. Yeah.
Right.
And actually, it's ironic. When I put the strategies together back when, I mean, I was looking at various things, and I could see that using TLT actually had a very small but a positive higher CAGR over VGLT.
Right.
I actually chose not to use it. I wasn't trying to be different or anything. I was just I really like the Vanguard products a lot, so I was using VGLT, knowing that it had a slight less performance than TLT. But
Yeah,
again,
I've
switched
noticed
it here recently just because of the increased volume that it has.
Right. No, I would rather trade TLT or IEF because they both do slightly better than VGLT and VGIT, but I'm happy using VGLT and VGIT,
Yeah.
especially when you buy in the open and you don't have any bid-ask problems.
Right.
I've got a question, Randy. This is Ren Curry. When do you decide between QLD and SSO for the leveraged one, or TQQ and the other? What do you choose, the NASDAQ version versus the S&P?
That's strictly based on so for any of the strategies that use leverage, they always look at the base 1x version for the look back. I don't look at leverage products for a look back purpose for performance.
Okay.
So in the case of the Russell, it uses the Russell 1000, the Russell Mid Cap Growth, and the Russell 2000. So if the 1x version of those has the highest look back and smart leverage kicks in, then we would go into the, if the Russell 1000 had the highest relative momentum, we would go into, if it was the Russell XXL, we would go into UPRO. If it was the Russell, we'd go into SSO. There's no decision between, which leverage product. We're simply going with the leveraged one that correlates to the base product, which has the highest relative strength.
Yeah, but QLD is a NASDAQ, right?
Yeah, QLD and the triple Qs are NASDAQ 100 leveraged, and they are the closest leverage I can get to IWP, the mid cap growth. They move very, very similar. I know they're not the exact same thing, but I use those to lever up the mid cap growth.
That's what I wanted to know. Thanks.
Yeah. Yeah, and I know that's not perfect. It's just one of those concessions I had to make because there's not a leverage product for the mid cap growth.
Okay, well, Randy, another great presentation. You always
Thank
come
you.
up with some good stuff. We always like to have you, and last time people were really happy with your presentation. I'm sure they're happy this time.
Great.
Bravo,
Great.
bravo.
Yes.
Thank you. And by the way, I didn't really add it on here, but for anybody who wasn't here last time or didn't reach out and want to this time, obviously no obligation. I do all my decks and everything. I don't charge for it, but if you would like to be on the distribution, if you have any questions, feel free to reach out. My email's on this PDF. I'll email. I changed just a little bit before I sent it to, or after I sent it to Don. I'll send him an update, and anybody who would like a copy of it in the deck, you can either ask myself or Don, and we'll shoot it over to you.
Okay, very good, Randy.
Yeah. Thanks, everybody. I appreciate having me on again.